Very good afternoon, and what a great one it is. Welcome to today's episode of Market View. It is the last episode of the month of March, and certainly going to be a good one as we march to the next month, the month of April. We're about to enter the last month of the first quarter, I beg your pardon, and we will continue to, track all the developments that are happening around the Kingdom of Eswatini under the business landscape. We trust that everyone is doing well today. This is what is on our agenda. News: the Ministry of Agriculture is working to increase imports from South Africa while ensuring that local production is also scaled up. Now, this initiative aims to facilitate the easy movement of goods across borders. Nosiwe Ntagamandla is going to report on that story and speak to Honorable Mandla Chauka, the Minister for Agriculture. We will also hear some public opinions on the initiative by the ministry. Our Enterprise Watch today looks at the Ministry of Labour and Social Security, which has announced the demonopolization of workmen's compensation, opening up the market for employment injury insurance to other companies effective tomorrow. Now, increased competitions, there's now questions that are arising about whether premiums are going to remain equitable and fair for all workers. This is regardless of their industry or their role. Now, to address these concerns, our journalist Nelson Ntagamandla interviews Jabu Masina, who is the Acting Commissioner of Compensation from the Ministry of Labour and Social Security. And she explains how this new system is going to ensure fair payouts for the workers. Again, Nelson Ntagamandla leading the reporting there, as well as all the investigative journalism there, speaking to Jabu Masina. Our market analysis: global stock markets are experiencing significant declines. This is amid escalating trade tensions. We are seeing the S&P 500 decreasing by 1.97%, closing at 5,580.94. On the other side, the Dow Jones Industrial Average is falling by 1.7%, ending at 41,583.90. While in Europe, Germany's DAX dropped by 1.9%, and the UK's FTSE 100 declining by 1.39%. Asian markets there seeing a lot of downturns, with Japan's Nikkei 225 falling by 4.05%, and the Hong Kong's Hang Seng Index decreasing. Now, gold prices, obviously, they continue to surge, and we are seeing record high numbers. These numbers we have never seen, and Sandeles Bia has been, telling us why right now they are the safest of havens it has ever been, this gold. We are going to understand again today how it continues to surge high. Let's dive into today's discussions. We'll start by looking at the news. For our first story, the Ministry of Agriculture is working to increase imports from South Africa, whilst also ensuring that local production is also scaled up. Now, this has been said by Minister Mandla Chauka during the second annual Business to Government Dialogue at Royal Villas, Eswatini.
We still are working to also improve the ease of getting stuff from across the border. For instance, recently South Africa published what they call a VPN, veterinary notice, that says you can get animals from Gauteng, Northwest, Mpumalanga, and Limpopo. And as a ministry, we set up a committee that includes ministry officials and stakeholders. There are people that come from the private sector that sit in that committee to deal with this problem and make it more manageable going forward. In fact, to indicate that we are working very hard, I do want to state that as business people as well, we must promote local production. We shouldn't be excited about imports.
Different industry leaders have shared their views on what they would like to see in terms of the country's economic direction.
These solutions have potential to drive in digital transformation, to enhance efficiency and create employment opportunities for the youth of Eswatini. May I request for a platform to present these impactful solutions and how we can work closely with the government?
We have lobbied before to the Ministry of Finance to have VAT removed from all canned fish and protein meat products, as well as chicken IQF in the supermarkets, as it is that way in most of the SADC countries in Southern Africa.
Flood us with digital literacy. Let us ride the waves of the future. And lastly, to the Prime Minister's office, may you demand impact assessments for every law that touches us as young people. Hold yourselves accountable as we hold ourselves ready. This is not a suggestion. It's a mandate from the future to the present.
The views and resolutions from this meeting will help in ensuring that the country takes a different stance in terms of ensuring economic sustainability. For Market View, Nelson Dlangamandla, Thembinkosi Mavimbela, Ezulwini.
We jet off now and we look at international news, negative energy prices, why cheap electricity can create huge problems. The last 3 years have seen a rapid increase in the renewable energy production across much of Europe. But thanks to the variability of solar and wind energy, sometimes more energy is being produced than can actually be used, which tips prices not only into ultra-cheap territory, but sometimes into the negatives.
The renewable energy sector in Europe is growing. Between 2004 and 2023, the share of renewable energy almost tripled, rising all the way to 24.5% in 2023. Every kilowatt hour brings us closer to a renewable future and a green utopia and a cleaner climate. But wait. In very simplistic terms, energy providers make money by matching demand and supply of electricity. But a negative energy price happens when there's more energy being produced than there is demand, and the balance gets out of whack. For example, on bank holidays, factories, stores, and offices are closed, so they don't need energy to operate. But if it's a sunny summer holiday, well, those solar panels, for example, are still on, even as demand is lower. And when supply is a lot bigger than demand, prices get cheaper and cheaper and cheaper until they slip into the minus. That's where the word negative comes in. Some of the analysts we spoke to say that there are some interest groups worried about investing in projects that won't make a return. We heard some concerns and anecdotal stories of investors hesitating or asking more questions about the viability of these green energy project investments. So, economically, negative energy prices are potentially good for the consumer, but currently bad for producers and investors. Currently, the vast majority of hydrogen made in Europe is made with fossil fuels, with various processes that fall under the umbrella term reforming. Only a small sliver of hydrogen is green. And zooming out even more, at the moment, hydrogen makes up a tiny part of the European energy mix, just 2%, at least in 2022. And looking at the costs of this technology, on the startup side, green hydrogen is much more expensive than solar panels, for example, which have become remarkably cheap, with China dominating the market. But as we've laid out, there is no silver bullet in the green energy transition, since commercial storage batteries really hold energy best for a few days maximum. But for weeks or months like this, other solutions will be needed. Negative energy prices have been on the rise in Europe for a few years. While potential solutions for storing excess energy and helping to regulate market demand do exist, there's currently no silver bullet. Green hydrogen could be part of the puzzle, but the energy conversion rate is low. To maintain investment in the renewable sector, there'll need to be a better balance between energy supply and demand, ensuring renewables don't become a victim of their own success.
That's it for our business news. We'll go for a net break. We'll return and get into our Enterprise Watch segment.
Eswatini TV has signed a code of conduct that is enforced by the Eswatini Communications Commission. We are committed to reporting news that is accurate, comment that is fair, and programming that does not amount to hate speech or the description of gratuitous violence or explicit sex. For any complaints of our programming, please contact us on 2411-9600 or email info@eswatinitv.co.za. You can also contact the Eswatini Communications Commission on 2406-7000 or write a letter to ECCOM on PO Box 7811 Mbabane. Email address is info@ecom.org.za.
Welcome back. For years, the workmen's compensation was held under the Eswatini Royal Insurance Corporation. Now, the Ministry of Labour and Social Security has announced its demonopolization, opening up the market for employment injury insurance to other companies effective tomorrow. With so much competition, will the premiums be equitable and fair for all workers, no matter their industry or their role? To answer these questions, Jabu Masina, Acting Commissioner of Compensation from the Ministry of Labour and Social Security, she sits down for an interview with our business journalist Nelson Langamandla, and she explains if this new system will still actually ensure fair payouts for workers.
Thank you so much, Commissioner, for joining us on Market View. We heard that the Ministry of Labour and Social Security is demonopolizing the workmen's compensation. My first question to you is, what is the current structure of the system?
Within the Ministry of Labour, we have a Social Security Department, which basically is looking into issues of compensating employees who are injured on duty, amongst other benefits as per the ILO standards. So when we talk of the issue of workmen compensation, what happened was we had a regulation, we have an act that guides us in the operations. It's the Workmen Compensation Act number 7 of 1983. So the act compelled us that each time an employee gets injured on duty, they have to report to their immediate supervisor, and the supervisor would then report to the Ministry of Labour through a form that is called an injury on duty form or dangerous occurrence. From there are processes that take place which also involve doctors who are then able to determine if that particular employee incurred a disability or not. It is also worth highlighting that the current structure of the workers' compensation only compensates permanent disability. We do not compensate an injury because some injuries do not result into a disability. So basically, that is what is on the ground now. We compensate permanent disabilities, which is also prescribed by a medical doctor. There is a form that they fill in notifying the Commissioner of Compensation that this particular employee has incurred a disability, and they also quantify it in terms of percentages, whether it's a 5%, 10%, but it depends on the extent of the disability that the particular employee incurred. So what happened was, as per the regulations, it was prescribed that the only insurance company that was allowed to sell the product was Eswatini Royal Insurance Corporation. So now that the government has made a decision to actually demonopolize the selling of the product, now what is going to happen is all other insurance companies, actually licensed short-term insurers, are the ones who are going to sell this particular product to any employee in the country. So there is nothing basically that is going to change in terms of systems and operation, except that as government, we are now not going to deal with one insurance company, but with several insurance companies which are licensed and approved by the Financial Services Regulatory Authority.
What are the benefits of having a number of players now?
Okay, basically the demonopolizing process is going to assist the employers. The employers had a challenge whereby there was an outcry that in terms of premiums, they were high and they couldn't afford. So now that we have demonopolized the system, what is going to happen with having more than one player on the ground? There's going to be a competition whereby the different players are going to charge as per their liking in order to attract customers. It's going to depend on each and every industry, in each and every insurance company, how they're going to charge this particular product. As labor, we do not interfere much in terms of the premiums, but the insurers are the ones responsible. From our end, we are expecting issues of compliance from all the employers, because what we anticipate now is that no one is going to make an excuse that, no, we couldn't afford a workers' compensation policy because it was not affordable. With different players, we know that someone, somewhere, you'll be able to get a price that is going to be convenient for you as an employer and as a ministry. We are expecting full compliance from all employees to cover all their employees.
Njengoba usho Commissioner kwekuthi now there'll be a number of players, is there a certain amount, a capped amount, kwekuthi inkampani kufanele ukuthi inikete i-premium lengaka, so that we don't find ourselves in a situation where workers ayalimala emsebentini but imali lesebanikwa yona seyincane kakhulu because of this competition now kwekuthi lomnye so tayibeka ibe le phasi kuze phela a-attract emakhasimende.
Within the regulations of the Act, we do have a minimum wage and a maximum wage. So they can use that in terms of pricing. Currently, the minimum wage is 3,755 emalangeni 30 cents. And the maximum wage that we are using for calculations, it's 25,033 emalangeni. So those are the capped amounts that are there that they can play around from. We also have a hospital benefit, because once the employee gets injured, it's also the responsibility of the employer to make sure that this particular employee gets medical attention and is assisted up until the doctor determines if this particular person has suffered a disability or not. And when it comes to issues of the medical expenses, there is a cap as well, which is currently standing at 136,033 emalangeni. So what we are doing as a ministry, in as much as we do have these capped amounts, we are also working towards reviewing them, because when you talk of 133,000, you find that this particular person or employee who's supposed to get more than one operation is then not being assisted because of that the cap amount, which is standing currently at 136,000.
You have said there are going to be a number of companies. I want to know, how did you identify them and how are you going to ensure that you monitor them properly?
Okay, maybe I can highlight that in this whole process of identifying the insurance companies, the Ministry of Labour was working hand in hand with the Financial Services Regulatory Authority in determining which are the rightful insurance companies that we can then use in this particular process. They gave us a list of about 5 insurance companies, inclusive of SRIC. So we do have a list of companies, and there is a process that they need to follow. They have been sensitized on that particular process that they need to follow in order for them to get that kind of approval. So in terms of monitoring, we'll be working hand in hand with the FSRA just to see if those short-term insurers are complying with the Act. Moreover, we are also going to have inspections that are going to be conducted by the ministry to determine that. As a ministry, we also have an open door policy where employees are able to come and make those complaints. Whatever complaints that are going to come up in terms of non-payment or in terms of not reporting, we also make a follow-up in that regard.
I would have loved for you to outline some of the sectors or companies that are defaulting in terms of workmen's compensation, but because of time, now I want you to speak to the different companies in terms of ensuring that they comply with the law in terms of workmen's compensation.
Okay, when it comes to issues of compliance, we would actually encourage all employers to make sure that they take the product, because issues of dangerous occurrences within the employment space is something that you cannot determine. Those issues, they just happen as and when. And when such an accident happens, as a ministry, we expect every employer to do due diligence and also to follow the Act and the regulations as well, in terms of reporting, in terms of making sure that the employee is being assisted medically until the last stage. And also, if there is a compensation, we expect every employer to make sure that their employees are compensated as per the expectation from the calculations that are being done within the ministry. So we really encourage every employer to take this particular product and to make sure that they have an active insurance cover with any short-term insurance company of their choice.
Thank you so much, Acting Commissioner, for joining us on Market View. The demonopolization starts 1st of April, which is tomorrow, right? We are hoping that different companies will take this as an opportunity to ensure that Eswatini get the right compensation and on time. And we will always check with you if the different companies are complying.
And that's it for our Enterprise Watch segment. We'll go for a net break. We'll return shortly with our market analysis.
Eswatini TV has signed a code of conduct that is enforced by the Eswatini Communications Commission. We are committed to reporting news that is accurate, comment that is fair, and programming that does not amount to hate speech or the description of gratuitous violence or explicit sex. For any complaints of our programming, please contact us on 2411-9600 or email info@eswatinitv.co.za. You can also contact the Eswatini Communications Commission on 2406-7000 or write a letter to ECCOM on PO Box 7811 Mbabane. Email address is info@ecom.org.za.
All right, welcome back to the program. With exactly 7 minutes left on our schedule, let us look at the markets leading the charge today in the financial landscape. Today, indeed, one of those days where traders will be clutching their coffee cups a little tighter, staring at their screens in disbelief, because from Wall Street to Asia, it's been a sea of red. We'll start with the U.S. markets. Want to see the America sneezing, the adage, the rest of the world catches a cold. That is what they say. The Dow Jones Industrial Average, home to 30 of the biggest companies in the United States, losing by 1.69%. Of course, a clear sign that investors are nervous about economic uncertainty. And then we look at the S&P 500 there at the top. Markets falling by 1.97%, nearly 2%. When this index drops, it tells us that the investors are pulling back across multiple sectors, not just in a few key industries. And then the Nasdaq 100 there, heavily weighted with tech companies like Apple, Microsoft and Tesla, obviously taking the biggest hit, down 2.7%. But why? Tech stocks are the first to suffer when interest rates are high. Investors are asking themselves many questions. How much more expensive will borrowing money get? And then we move over, we go to Europe now. We are seeing that the news there went any better compared to what we just looked at Wall Street. London's FTSE 100 dropping by 1.19%. The United Kingdom's economy is battling inflation pressures as well as slow growth. So investors obviously are playing it safe. Germany's DAX, 1.85%. Europe's economic powerhouse. It is known for that. But when it struggles, it sends jitters across the continent. France CAC 40 slipping by 1.77%, meaning that big French companies like L'Oreal, Louis Vuitton, and Airbus, they all took a hit. We move along, we buckle up as we go to Asia, and it looks like Asia was the worst hit. So indeed, you need to fasten your seatbelt here and buckle up. The numbers are not an interesting story. Nikkei 225 crashed by 4.05%. Yes, over 4%. This is in a single session. It's a major decline for an index of this size. It is something that we really haven't seen in recent history. Investors are worried about inflation, weak global demand, and a weakening yen. Hong Kong's Hang Seng Index, it fell by 1.31%, not as steep as Japan's, but still in the negative territory. And then China's Shanghai Composite Index, it lost by 0.046%, a small drop that is comparing, if you compare it to the other two. Of course, here, the real question becomes, is this the calm before the storm? China's economic recovery has been slower than expected. And if that continues, we could see bigger movements very, very soon. And then closer to home, South Africa, it also felt the pressure. The JSE All Share Index dipping by 0.77%, tracking global losses. Now, this one just simply means that investors in South Africa are feeling the pinch and pulling money out of the markets. And what about the kingdom of Eswatini? What about us here at home? No movement yet on the JSE All Share Index, but that doesn't mean we are immune. If our trade partners, especially South Africa, if South Africa struggles, it could eventually affect our businesses as well as investments. And this happens in the backdrop of, that government and private sector meeting where they are discussing trade as well as, how they continue to bolster our business sector. That conversation is very, very critical with everything that is happening in the world right now in the financial markets. And then let's talk commodities now. When the markets are burning, people look for a safe haven, right? Gold. It is rising. It is hitting unprecedented numbers. It is proving once again that when uncertainty is high, investors rush to precious metals. It's the classic when in doubt, buy gold type of move. But Brent crude also is edging up by 0.21%, meaning oil prices are steady. But don't be fooled. With all these ongoing geopolitical issues, we could really see, these tensions rather have an effect in wild swings in the coming days. So these numbers might really, really change, particularly for Brent crude. Anyway, finally, we want to check in on the currencies. We'll start by looking at the USD SZL pairing. The exchange rate there is increasing. It increased by 0.44%. Now, this one just basically means that the Lilangeni lost some ground against the United States dollar, and it could lead to higher import costs. The Euro SZL pairing, it moved by 0.47%, meaning European goods and travel to the Eurozone just got slightly more expensive. And then finally, the SZL against the Japanese pair, it strengthened by 0.56%, meaning that if you're looking to travel to Japan, your Lilangeni will go a little further. In summary, today is a reminder that indeed markets are unpredictable and investors are anxious. Central banks all over the world are calling the shots, but history has taught us one thing. It is that after every sell-off, there's an opportunity that is waiting. The question is, who will take advantage of that opportunity? That has been our market analysis today. We do want to extend an apology that we weren't able to connect with our market analyst, our in-house economist, Sanele Sibia, but we are working around the clock to make sure that all our connections virtually are fixed by tomorrow and we are able to connect with him and you get a more informed market analysis. That has been our Market View episode today on a Monday, the 31st of March. We'll see you again next month, which is tomorrow. Bye-bye.